Welcome to the Holistic Accountant Podcast. This is where we cut through conventional accounting and show you how a genuinely holistic approach drives better after-tax outcomes. It's not about ticking boxes or churning out tax returns. It's about strategic advice that builds lasting wealth. If you find this episode valuable, leave a rating and share it with someone who will benefit. Okay, today Mena and I would like to talk about gross margin and gross profitability. So that's really a very simple explanation. We'll get a bit deeper into it. Gross margin really measures how much incremental profit you make by selling a one unit of product or good or service, whatever your business is. Now, you might make a gross margin of 40%, but after you subtract all costs, overheads, those sorts of things, you might end up with a net profit margin of say 15%, which isn't terrible depending on the type of business that you're in, but it's questionable whether you're being rewarded for the risk and capital that you've contributed into the business. So making sure you're on top of your cost of sales and your gross margin is incredibly important. And I would argue you almost reverse engineer it. You can do that in many industries, not all though, so that what you need to do is work out what your net margin needs to be so that you're rewarded for, as I said, the risk of running the business and the capital that you've got to contribute. Of course, after factoring in, a reward for your personal exertion, so a salary, and then that'll tell you what your gross margin needs to be in order to earn that net margin. And that's a very, very important exercise. In addition to that, it's very important to understand what those direct costs are and what to include in cost of sales and what to exclude in cost of sales. Because again, if you don't have a really robust process, you might not be running as sustainable business as you expect. And it's very easy to set prices incorrectly if you don't have the necessary information. So Mena, let's start by talking what costs should we be including in cost of goods sold?
Simply put, it should really be the direct costs that are required to deliver the particular product or service that you're providing. So for trading or services businesses, for example, this could include direct materials and labor, or from a service-based business, it could be around, for example, the direct work component. So the workers' component, wages, superannuation, workers' compensation, payroll tax. Now, we only want to include basically the cost of remuneration for the direct wages that are attributable to the direct cost itself. So, for example, if you've got fixed costs, like head office costs, for example, that's not typically in your GP line. That's not typically included in your direct costs. It's more so any costs that are directly attributable to delivering the product or service. So contractors being another one, production related freight. So anything that, you need to incur to either receive your direct materials or even ship the product that you're selling. These are the typical things that would include it in your direct costs. So basically, the general rule of thumb is if removing the cost stops revenue, then it should typically belong to your cost of goods. So basically, direct costs are variable in nature, whereas overheads tend to be, or things that are below the direct cost, below your COGS item, tend to be rather sort of fixed in nature or slightly variable. So think of things such as, like I mentioned before, head office expenses or rental, your underlying lease for your business. So Stuart, how do businesses work out their markups?
Not accurately is probably the most common assessment or description, Mena. Look, I think that the issue is that quite often, and particularly if we're selling a product, quite often we work out markups based on the cost of the raw material, what we've bought the good from a wholesale perspective, and that you end up making a mistake, particularly if you haven't worked out, what other costs need to be included in that cost of goods sold. So ignoring labor on costs, for example. So we might include some salary, but we forget that we've got to pay payroll tax or super contributions or work cover, these sorts of things. You normally want to add maybe around 14-15% for employee on costs. Could be higher depending on how much work cover costs in your business, and particularly also payroll tax as well. Ignores waste and inefficiencies. So again, if I'm a retailer, I'm going to probably suffer shrinkage, particularly if I have retail outlets in Victoria, given what's going on crime-wise down here. But, you need to factor all those sorts of things into your margin. Rework, of course, that's not appropriate if you're a retailer, but, if you're a service-based business, you need to think about those things as well. And if you are a service-based business, you need to have a good way of measuring labour cost associated with any additional unit of sale. That can be challenging depending on the type of business that you're in, particularly if no one wants to do timesheets and those sorts of things. But the point is, you've got to have a way of measuring it, and you've got to have a way of measuring it correctly. So, if I just look at material costs and say, look, I bought this T-shirt for $60, I'm going to sell it $100. I might sit there and think, well, my margin's 40%, that's healthy enough. But really, if my direct costs, labor, on costs, all these sorts of things, maybe my margin's closer to 15% rather than 40%. And I don't think that there's any retailer out there that would disagree with me to say that 15% gross margin is way too thin, to cover rent and other expenses. So, Mina, what's the risk of making this mistake with respect to, perceived margins or what we think the margin is, but it could be something different?
I'm going to talk simple numbers here, basically, and that just to illustrate how a small margin improves or is better than improving your revenue. So let's say your business does $3 million in revenue at a 15% gross profit. So that means you're achieving about $450,000 of gross profit. Now, if we only improve that GP by 3%, so we're increasing the GP from 15% to 18%, then in dollar values, that's 540,000 GP profit, so a $90,000 uplift. Now, to achieve the same $90,000 uplift at a 15% GP, you actually need to increase your revenue by $600,000. So that shows how a small improvement in margin improves your overall wealth more than basically just gunning for sales. So it's really important to understand what your GP is and how a volatility in GP can result in drastic changes in your underlying profit. So sure, I think we had a real life example with a client recently who experienced this sort of fluctuating GP. Do you want to walk us through it?
Can I say no, Mina? Of course. Now, this client listens to the podcast, so I've got to say that we're not picking on this client. The reality is that we're desperate for topics for episodes. And so when we spot one during a client conversation, a lot of our ideas come from client conversations. We have to talk about it. But essentially, we were looking at this client's P&L on a monthly basis, and the gross margin was jumping all over the place. It was quite variable. That's a bit of a red flag from our perspective as holistic accountants. We really want to understand what's going on because it can hint at a couple of different problems: inconsistent pricing, mismatch of revenue and expenses, timing differences, uncollected revenue, overpayment of expenses. Look, there could be lots of different reasons why this is occurring. And what we should see for most businesses, not all, of course, but for most businesses, is consistent gross margin, especially on a month-by-month basis. And even if there is some volatility in business, then even looking on a quarter-by-quarter basis, we should see a lot of consistency there. So what was happening in this situation is that services were being rendered. We were paying for direct costs when those services were rendered, but for a variety of different reasons, the services weren't always billed on a timely basis. And so in this situation, what the gross margin analysis did is identified a key risk to this business, because what happens is essentially the business owner is funding those services until the customer pays. And that's not this business owner's core business. This owner's core business is delivering those services, not acting as a bank. And, if this problem become very widespread and this business enjoyed strong growth, it does enjoy strong growth, but even stronger growth, actually it could blow the business up in terms of there'd be a shortage of cash flow. So it's something so simple as looking at gross margin, we might, overlook it, maybe even as accountants and certainly as business owners. But this one exercise certainly helped us identify a key weakness in the billing and accounting function in this business, which we have helped them rectify and close a key sort of business risk or gap. So the more precise you can be about your gross margin, now it depends on the type of business that you're in. A service business And again, depending on the service they're providing, doesn't necessarily need to be as accurate as a manufacturing or product-based business. But really, an accounting system there is to give you actionable, timely information. So it's there to help you make sure that your business is tight as possible. So in this instance, for the example that I just shared, we're just not billing fast enough, early enough, soon enough. So we need to tighten that up. That's a key thing or key process within a business. So really having accurate information is fundamental. So Mena, maybe you can walk us through that.
Like we always say, Stuart, you can't manage what you don't measure. Now, if you don't sort of have the precision in your numbers, then you're not going to be precise in your wealth. So you need to understand what your true margins track your labor recovery rates, monitor your job profitability, measure contribution margin. Now, I've always frequently spoken with my clients about actually setting up tracking categories or processes within your accounting system so you can understand what a particular product or service is actually costing you. Now, if you don't have that information, you can't price properly. You can't hire ahead of schedule. Now, if you're under-resourced, then you compromise the quality of your product or service. And then finally, you can't scale. Because if you try to grow your business with poor numbers, without precise numbers, then you're going to basically fail. You don't have your underlying foundation ready. You need to have these numbers and understand your numbers so that you can actually grow your business safely and understand what it takes from a resourcing perspective to support that actual growth. So the first thing I would do is then to look at what should actually be included in your direct costs. So things such as what is the direct supervision time? What is the owner production time? So if you are actually involved in producing a particular product or service, is that represented in your direct costs? What are your chances of rework? What's the percentage of rework that you do? How do you factor that in as a contingency in your direct costs? What kind of warranty work do you do and how often does it actually incur? Do you have insurances in place, for example, for that warranty work that you're compensated for? And if so, how often is that being actually submitted for a claim? What kind of small consumables do you actually have within your business that are attributable? Because even the smallest of nails, if it's used at a high volume in your business, then it needs to be accounted for. And then finally, what credit or merchant fees are actually incurred? Margins, especially if you're a low margin business, can be affected by the smallest of increments in indirect costs. So it's really important that you capture all these in your direct costs so that you can price correctly and scale correctly.
So who knew a relatively dry topic could be so interesting? I say that in jest, of course, a little bit facetiously, but it's true. The gross margin is an incredibly important decision. It informs us around pricing decisions, allows us to control costs better, also react to a change in costs or a change in pricing. And it all falls back on to making sure that your accounting system is correctly reflecting, allocating all the costs associated with incrementally selling one additional good or service. And it's not insurmountable. It's a relatively easy thing to get right, but getting it right can really help you in terms of managing your business. And when you do see some variability, like the case study that we shared with you today, it can be a red flag for further investigation. And the sooner that you identify these things, the sooner that you can get on to making sure your business is as robust as possible. Okay, that's enough excitement for one day. We'll leave it there until next week. Bye for now.